Hello, it's Wednesday the 8th. I'm FxPlew. This is the market brief, and we had snow. Now, historically, the UK has always had relatively high interest rates. As such, in the past, when the Bank of England needed to raise rates to deal with higher inflation, rates became pretty restrictive pretty quickly because of the higher starting point. However, after the financial crash and then after COVID, UK interest rates were near zero. And with such a low starting point, it has taken really quite a long time for rate hikes to start restricting demand. Many would argue that we're only now around the neutral point, so it's no wonder the Bank of England has been criticised for their string of dovish rate hikes over the past 15 months. Many believe we still need at least 0.5% more for rates to become truly restrictive. But while the MPC did not want to tip the UK into recession, inflation has remained untamed and problematic. The economy is in a state of flux. Data is really confusing the markets, and with Bank of England policy pretty unclear, the currency remains vulnerable. Against that backdrop, the only real support for sterling is coming from the expected yield appeal of higher UK rates. If we take that away, especially when the Fed is still hiking rates, sterling would surely tank. Indeed, we dropped to 118.20 against the dollar yesterday because over in the US, Powell's testimony to Congress was pretty punchy. He expects to raise rates further given the strength of the data released so far this year. Perhaps therefore we'll be in for another bumper non-farm payrolls on Friday. Tune in to find out. But he sounded like he felt that the smaller 25 basis point rate hike was a mistake last time out, and he gave no reason to avoid returning to 50 basis point rate hikes. Data-driven decisions and all that. Powell said rates will likely peak higher than previously expected, and this saw market sentiment shift to a 6% peak, up from 4% just a few months ago. It's worth noting that if rates do go to 6%, some analysts already fear the Fed will need to cut rates in H2, which will affect bonds, equities and the dollar. For now though, the dollar rallied pretty hard. The dollar index broke resistance at 105.30 and closed at the peak around 105.65. Sterling fell through support at 119.25 and dropped down to 118.20. We open around 118.25 against the dollar. We're about 112.15 against the euro, and euro dollar is down around 105.40. Go on the dollar. Right, that's it from me. I'm off to make a snowman. Maybe throw some snowballs at Bertie. Toodaloo.
If you do not have a clue, then just tweet through and ask FxPlew.